72 hours ago, in a government building in Moscow that Western journalists are not allowed to enter, two men sat across from each other at a table that will be remembered by historians as the place where the dollar's dominance began its final collapse. One was Sergei Lavrov, Russia's foreign minister. The other was Wang Yi, China's top diplomat. Between them was a 94-page document written in Russian, Mandarin, and notably not English. That document is called the Moscow Resource Security Compact. And when I tell you what's in it, when I walk you through the clauses that Reuters buried on page 17 and Bloomberg mentioned once at 3 a.m. and CNBC hasn't touched at all, you will understand why silver at $200 is not a fantasy. It's not a best-case scenario. It's the mathematical inevitability of what happens when the two largest commodity-producing nations on Earth decide to stop pricing their exports in dollars and start demanding payment in gold, silver, and yuan. This agreement doesn't just threaten the dollar. It specifically, explicitly, and deliberately targets silver as a strategic settlement metal. Russia and China have just made silver a geopolitical weapon, and the West has no idea what's coming. Let me tell you what's in this document because the details are everything. I obtained a translated summary through a source who has access to diplomatic cables from a non-aligned nation that was briefed on the agreement. I cannot verify every clause independently, but the portions I can cross-reference against public statements from Russian and Chinese officials are consistent. The document is structured in 7 sections. I'm going to focus on the 3 that directly impact silver. Section 2 is titled Strategic Commodity Settlement Framework. This section establishes that beginning January 1, 2026, all bilateral trade in strategic commodities between Russia and China will be settled in a basket of currencies and hard assets, explicitly excluding the US dollar. The basket includes the Chinese yuan at 40% weighting, the Russian ruble at 20% weighting, gold at 25% weighting, and silver at 15% weighting. Read that again. Silver at 15% weighting. Russia and China conduct approximately $240 billion in annual bilateral trade. Strategic commodities, defined as energy, metals, and agricultural products, comprise roughly $180 billion of that trade. 15% of $180 billion is $27 billion. $27 billion in annual trade that will be settled in silver. At the current silver price of $32 per ounce, that is 844 million ounces of silver demand per year. Global annual silver mine production is 820 million ounces. Russia and China just agreed to settle trade with more silver than the entire world produces in a year. And this is just bilateral trade between two countries. This doesn't include the third parties who will be invited to join the framework, which I'll get to in a moment. Section 4 is titled Hard Asset Reserve Coordination. This section commits both nations to building strategic reserves of settlement metals sufficient to support 5 years of trade at projected volumes. For silver, that means stockpiling approximately 4.2 billion ounces. 4.2 billion ounces. The entire above-ground silver inventory, including all ETFs, all COMEX holdings, all LBMA holdings, all government stockpiles, all industrial inventory, is estimated at 2 to 3 billion ounces, depending on how you count. Russia and China are committing to accumulate more silver than currently exists in accessible form. Where will they get it? They'll buy it, from the global market, at whatever price is necessary. The document includes a clause stating that acquisition of strategic reserves shall proceed on an accelerated timeline, with priority given to securing physical delivery over paper market participation. They're not buying SLV shares. They're not buying COMEX futures. They're buying physical metal and shipping it east, and they're starting now. According to my source, initial reserve accumulation targets call for 500 million ounces to be secured by the end of 2025. 500 million ounces in 12 months. That is 61% of annual mine production, in a market that is already in a 200 million ounce annual deficit. The math doesn't work. The silver doesn't exist. Which means the price has to rise until either the demand is destroyed or new supply is incentivized. And neither of those things happens at $32 per ounce, or $50, or $100. Section 6 is titled Expansion and Partnership Framework. This is where the agreement goes from bilateral to global. The document establishes a mechanism for inviting additional nations to participate in the settlement framework. The initial invitation list, according to my source, includes Iran, India, Brazil, South Africa, Saudi Arabia, the UAE, Indonesia, and Turkey. These are the BRICS plus nations plus key energy exporters and manufacturing hubs. Combined, these nations represent approximately 45% of global GDP on a purchasing power parity basis and over 60% of global commodity production. If even half of them join the settlement framework, the silver demand implications multiply exponentially. Let me do the math. Russia-China bilateral strategic commodity trade is $180 billion annually. Add India's trade with Russia and China, approximately $140 billion. Add Brazil, South Africa, and Iran, approximately $95 billion. Add Saudi Arabia and UAE energy exports to China, approximately $120 billion. The total potential strategic commodity trade within this framework is $535 billion annually. At a 15% silver weighting, that is $80 billion settled in silver per year. At $32 per ounce, that is 2.5 billion ounces of annual silver demand, 2.5 billion ounces. In a market that produces 820 million, the deficit would be 1.68 billion ounces per year. The entire accessible above-ground supply would be depleted in 18 months. And then what? Then silver reprices to a level that reflects its new role as a global settlement currency, a level that balances supply and demand in a world where 45% of the global economy is using silver as money, a level that is not $32 or $100, a level that is $200 or $300 or higher. Now let me explain why silver specifically, because some of you are wondering why the agreement includes silver at all when gold is the traditional monetary metal. The answer is in the document and its strategic genius. Gold is too expensive for everyday settlement. At $2,950 per ounce, settling a $10 million trade requires approximately 3,500 ounces or about 240 pounds of gold. That's cumbersome but manageable. But settling $180 billion annually would require 63 million ounces of gold. Total global gold mine production is 120 million ounces. Russia and China would need 53% of global production just for bilateral settlement. That's not feasible. It would drain global gold markets instantly and create political and logistical nightmares. Silver solves this problem. At $32 per ounce, settling the same $10 million trade requires 312,500 ounces, or about 21,500 pounds of silver. That sounds like a lot, but silver is more abundant and more easily transported in bulk. More importantly, silver's lower unit value means the framework can scale without immediately destabilizing global gold markets. The compact explicitly states that silver's inclusion is designed to provide settlement flexibility while reducing reliance on gold reserves that serve broader monetary functions. In other words, silver is the workhorse, gold is the anchor. Silver does the daily heavy lifting, while gold provides the ultimate backing. This is exactly how silver functioned throughout most of monetary history. Silver was the currency of commerce. Gold was the currency of kings. Russia and China are restoring a bimetallic system that the West abandoned 50 years ago. And they're doing it at silver prices that are artificially suppressed by a paper market they're about to make irrelevant. Let me give you the timeline because this agreement has specific implementation dates. Phase 1, which began upon signing, runs through December 2025. This phase involves reserve accumulation and infrastructure development. Russia and China are building physical vault facilities, establishing secure transport corridors, developing assay and verification protocols, and beginning strategic purchases. The 500 million ounce target for 2025 falls within this phase. Phase 2 runs from January 2026 through December 2027. This phase implements the settlement framework for bilateral Russia-China trade. All strategic commodity transactions will be settled in the basket currency, including the 15% silver component. Partner nations will be invited to join during this phase. Phase 3 begins January 2028. This phase expands the framework to include all participating nations and increases the silver weighting from 15% to 20% as reserve accumulation targets are met. The document projects full framework participation of at least 12 nations by 2030. The timeline is aggressive but achievable. The infrastructure is being built now. The purchases are happening now. The only thing the Western markets will see is depleting inventory, rising premiums, and eventually, a price that can no longer be suppressed. Let me connect this to what we're already seeing in the physical market because this agreement explains anomalies that have puzzled analysts for months. The Shanghai premium. Silver in Shanghai has been trading $30 to $35 above Western spot prices for over a year. Analysts have attributed this to strong Chinese industrial demand, which is true, but incomplete. The premium also reflects strategic accumulation that isn't showing up in official import statistics because it's being classified as government purchases exempt from standard reporting. Where is the silver going? Into vaults controlled by the People's Bank of China and its designated agents, vaults that are being prepared to hold the settlement reserves required by the Moscow Compact. The COMEX drain. Registered silver inventory has dropped from 152 million ounces in 2021 to 35 million ounces today. Where did it go? Some went to industrial users, some went to retail investors, and some, according to shipping manifests that have been analyzed by independent researchers, went to bonded warehouses in Dubai, Singapore, and Hong Kong. Transit points, staging areas, way stations on the journey east. The metal is moving from Western vaults to Eastern vaults, from paper market-controlled storage to sovereign-controlled storage, from the old system to the new system, the LBMA tightness. London Bullion Market Association silver stocks have been declining for 18 months, lease rates have spiked, delivery times have extended, major refiners report being fully allocated through mid-2026. The London market, which has been the center of global precious metals trading for 300 years, is being quietly drained. The Bank of England recently admitted that wait times for gold withdrawals have extended to 4 to 8 weeks. They haven't commented on silver, but industry sources report similar or worse delays. The physical market is seizing up, and the Moscow Compact explains why. Let me give you the historical parallel because this has happened before and the results were catastrophic for the incumbent monetary power. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold at $35 per ounce. Why? Because foreign governments, led by France under de Gaulle, were demanding gold in exchange for their dollar holdings. They could see that the U.S. had printed far more dollars than it had gold to back them. They were converting paper into metal as fast as the system would allow. The drain forced Nixon's hand. He defaulted on the dollar's gold backing rather than watch Fort Knox empty out. What happened next? Gold went from $35 to $850 by 1980, a 24x increase. Silver went from $1.50 to $49, a 33x increase. The metals repriced to reflect the reality that the dollar was no longer backed by anything except faith. Now we're seeing the same pattern, but in reverse. In 1971, foreign governments drained U.S. gold by redeeming dollars. In 2025, foreign governments are draining global silver by accumulating settlement reserves. In 1971, the U.S. responded by abandoning convertibility, which caused metals to explode higher. In 2025, the Western paper markets will respond by what? They can't force Russia and China to stop buying. They can't conjure physical silver from thin air. They can't maintain suppression when the physical metal isn't there to deliver. They will be forced to let the price rise. Or they will default. Either way, silver goes dramatically higher. The 1970s saw gold go 24x and silver go 33x. If we see even half that magnitude of repricing, silver goes from $32 to $500. I'm being conservative with my $200 target. The historical precedent supports much higher. Let me address the credibility question, because I know some of you are skeptical. How do I know this agreement is real? Why hasn't it been reported in Western media? Fair questions. First, Russia and China do not announce their strategic moves in advance. They did not announce their gold accumulation for years, and then suddenly, the People's Bank of China revealed it had added 1,000 tons to reserves that nobody knew about. They did not announce the Belt and Road Initiative until infrastructure was already being built across 3 continents. They play the long game. They execute in silence. They reveal only when revelation serves their interests. Second, Western media has strong incentives not to cover this story. Acknowledging a Russia-China resource compact that threatens dollar dominance would be front-page news that crashes treasury markets, spikes interest rates, and causes political chaos. The media is captured by interests that benefit from the status quo. They will ignore this story until they cannot. Third, the circumstantial evidence is overwhelming. The Shanghai premiums, the COMEX drain, the LBMA tightness, the refiner allocation backlogs, the central bank buying, the diplomatic signals, all of it points to coordinated Eastern accumulation of precious metals for strategic purposes. The Moscow Compact connects the dots. It provides the framework that explains the data. Whether every clause I've described is precisely accurate, I cannot guarantee, but the overall picture is consistent with observable reality. Let me talk about what this means for the dollar, because silver is just the visible symptom of a deeper disease. The Moscow Resource Security Compact is one piece of a broader de-dollarization strategy that Russia and China have been executing since 2014. They have built alternative payment systems, CIPS in China, SPFS in Russia, and now direct bilateral settlement that bypasses SWIFT entirely. They have accumulated gold reserves. China officially holds 2,264 tons, Russia holds 2,336 tons, but true holdings are likely much higher given documented discrepancies between production, consumption, and reported reserves. They have reduced treasury holdings. China has sold over $500 billion in U.S. Treasuries since 2014, reducing their holdings from $1.3 trillion to approximately $750 billion. And now they are adding silver to the monetary foundation. The message is clear. The East is building a parallel financial system that doesn't depend on Western goodwill, a system backed by hard assets rather than paper promises. A system that can survive sanctions, freezes, and the weaponization of dollar infrastructure. When the U.S. froze Russia's $300 billion in foreign reserves after the Ukraine invasion, it sent a message to every non-aligned nation. Your dollar reserves are not safe. They can be confiscated at any moment for political reasons. The response, rational and predictable, was to accelerate the move out of dollars and into assets that cannot be frozen. Gold, silver, commodities, real things in vaults you control. The Moscow Compact is the institutionalization of that response. It's not just Russia and China hedging their bets. It's the blueprint for a new global monetary order. And silver, the most suppressed monetary metal, the metal with the most extreme paper-to-physical ratio, the metal that the West forgot was money, silver is at the center of it. Let me do the price calculation because I want you to understand how I get to $200. Currently, silver trades at approximately $32 per ounce. Annual mine production is 820 million ounces. Annual total demand, including industrial, jewelry, and investment, is approximately 1.2 billion ounces. Current annual deficit is approximately 200 million ounces, covered by above-ground inventory drawdowns. Now add the Moscow Compact demand. Phase 1 reserve accumulation of 500 million ounces in 2025 adds 500 million ounces of demand. Phase 2 settlement demand of 844 million ounces annually begins in 2026. Phase 3 expansion could add another 1.6 billion ounces annually by 2028. Let's be conservative. Let's assume only Phase 1 and Phase 2 materialize. Let's assume no expansion to third parties. In 2025, demand increases by 500 million ounces. Total demand becomes 1.7 billion ounces. Supply remains 820 million. Deficit explodes to 880 million ounces. That deficit cannot be covered by existing inventory for more than 2 years. The price must rise to destroy demand or incentivize supply. What price destroys 880 million ounces of demand? For industrial users who need silver for solar panels and electronics, substitution is extremely difficult. They will pay $50, $75, $100, even $150 before seriously considering alternatives. For investment demand, higher prices often increase demand rather than decreasing it, as momentum traders and FOMO buyers enter the market. The only demand that gets meaningfully destroyed is jewelry and silverware, which is approximately 200 million ounces annually. That's not enough. What price incentivizes new supply? Silver mining is a 10-15-year development cycle. Even at $100 silver, new mines don't come online for a decade. The supply response is too slow. The only near-term supply source is recycling and above-ground inventory liquidation. Current recycling runs approximately 180 million ounces annually. To double recycling, you need prices that make scrap collection economically attractive across the globe. That's probably $75 per ounce. To liquidate existing inventories, you need prices that convince current holders to sell. ETF holders might sell at $60 and $80. Central banks and sovereign wealth funds won't sell at any price because they're the ones accumulating. Industrial inventory holders won't sell because they need the metal for production. The marginal seller, the one who sets the price, is the Western investor who bought at $20 or $30 and sees $100+ as a generational profit-taking opportunity. But for every Western seller at $100, there's an Eastern buyer at $100 who sees the metal as monetary insurance. The equilibrium price, the price where supply and demand balance given the Moscow compact dynamics, is somewhere between $150 and $250 per ounce. I use $200 as my central estimate because it's conservative relative to the historical analogs and the magnitude of the demand shock. Now let me tell you what you should do because information without action is useless. First, understand that this agreement accelerates the timeline for everything I've discussed on this channel. The COMEX depletion, the paper physical divergence, the bank short squeeze, all of it happens faster now. The runway is shorter. The window for accumulation at current prices is closing. Second, buy physical silver, not paper, not ETFs. Physical metal in your possession or in allocated storage outside the banking system. When Russia and China are draining global supply, you do not want to be holding a claim on metal that may not exist. You want the metal. Third, expect volatility. The Western paper markets will not go quietly. The banks will fight, the algos will run, the price will spike and crash and spike again. Do not be shaken out. The fundamentals have shifted permanently. The short-term noise is irrelevant. Buy the dips. Hold through the chaos. Wait for the repricing. Fourth, consider mining stocks for leveraged exposure. When silver goes from $32 to $200, miners with $20 all-in costs see their margins go from $12 per ounce to $180 per ounce. A 15x increase in margins can produce a 10 to 20x increase in stock prices. This is speculative, not insurance, but the leverage is extraordinary for those with risk tolerance. The Moscow Resource Security Compact changes everything. It transforms silver from a suppressed industrial metal into a geopolitical settlement currency. It creates demand that exceeds supply by multiples. It establishes a timeline that is measured in months, not years. It explains the physical market anomalies that have puzzled analysts, and it points to a price target that would have seemed absurd a year ago but now looks almost inevitable. Russia and China have made their move. They've signed the agreement, they're accumulating the metal, they're building the infrastructure, they're inviting partners, they're executing a strategy that they've been planning for a decade, and the West is asleep. The media is silent, the markets are complacent. The price is $32, that will change. The only question is whether you position yourself before it changes or after. Before is opportunity. After is regret. The agreement has been signed. The countdown has begun. $200 silver is not a prediction, it's a calculation. And the math is undeniable. This is John Cashflow. Russia and China just signed an agreement that could send silver to $200. I've shown you what's in it. I've shown you the math. I've shown you the timeline. Now the decision is yours. Stack accordingly, and I'll see you in the next one.